There are people whose entire job is beating the stock market, like Bloomberg terminals, research teams, finance MBAs.
People getting paid lakhs to pick stocks full-time and over 10 to 20 years.
Most of them still lose to a boring index fund. Not some of them, most.
And honestly, once you understand why that happens, investing starts looking very different.
Most people think successful investing means finding hidden stocks, timing the market perfectly, or being smarter than everyone else.
But the data says something way less exciting. Consistency beats intelligence way more often than people think.
Here's the difference. Active mutual funds try to beat the market. There's a fund manager constantly buying and selling stocks,
Trying to outperform the index. And for that, they charge you more, usually around 1% to 2.5% every year.
Index funds basically go, cool, we'll just buy the market itself.
A Nifty 50 index fund simply buys the 50 biggest companies in India and tracks the index. And the fees? Usually around 0.1% to 0.2%.
Now here's the crazy part. All these professionals with research teams and expensive offices,
Most still fail to beat a fund that literally just copies the market.
and this is where the math gets kinda insane. Let's say you invest 500 rupees every month for 20 years.
At roughly 12% annual returns, which is around the historical long-term range for the Nifty, that becomes almost 5 lakh rupees.
You personally invested only 1.2 lakh rupees. The market did the other 3.8 lakh rupees. That's compounding.
Now watch what happens with fees. Let's say an active fund earns 10.5% instead of 12% because of higher costs and underperformance.
That same 500 rupees SIP over the same 20 years becomes roughly 3.9 lakh rupees instead of 5 lakh rupees. That tiny 1.5% difference quietly cost you more than 1 lakh rupees.
That's what people don't understand. Compounding doesn't just grow investments, it also quietly destroys money through fees.
And this is why investing feels backward sometimes. The most effective strategy is also the least impressive looking.
Not trading every day, not chasing multi-baggers, not watching charts at 2 a.m.
Just low-cost index fund, direct plan, monthly SIP, long time.
And when the market crashes, you keep buying.
That's not the failure of the strategy. That is the strategy.
The investing industry makes a lot of money convincing people investing is complicated.
But for most people, the boring strategy wins.
500 rupees every month, index fund, 20 years.
You do not need to outsmart professional investors.
Statistically, most of them already fail to outsmart the market anyway.